Podcast is now starting. All attendees are in listen-only mode.
Good day, everyone. Thank you for joining our Business IQ webinar today. Part of our series to help you see new opportunities to grow and enhance your business. My name is Liam, and I'm part of the marketing team here at NetWealth, and I hope you are all safe and coping okay with this new way of working and the lockdown that's going on around the country. Today, I'm excited to be joined by Mark Hoven, CEO of Advisor Ratings. Over the next hour or so, Mark will be sharing some of the insights his team have been sort of looking into regarding the COVID-19 and the impact on advisors, as well as some of the key findings from the latest Advisor Ratings Financial Advice Landscape Report. Before we get into the good stuff, though, I have to run through some quick housekeeping items. There is a CPD point accredited for this webinar that will be sent around in a follow-up email after this presentation, or within a week of this presentation, so please be patient there. And to receive that point, you must have watched a majority of this session, so hang around for 30-45 minutes or so, ideally the whole of it though. In that email, you'll also receive a recording of this webinar along with the slides. And if you have any questions for Mark, in your little toolbar to the right of your screen, you'll see there's a questions panel. Please just feel free to type them in there, and we'll endeavour to answer as many as we can at the end of Mark's presentation. Now, a little bit about us. We are an ASX listed company who provide an online platform to support financial advisors with a wide range of financial products and services to help you manage your clients' investments and superannuation. So partner with us, an award-winning platform to start running your business the way you want to. Some of our key features include a market-leading advisor and client portal that is intuitive and easy to use, a mobile app to help you and your clients access key information on the go, a wide range of investment options such as managed accounts plus advanced transaction tools, a suite of detailed reports that can be tailored to your client and business needs, and access to unique insights designed to help you grow your business. As mentioned, we have Mark Hoven, the CEO of Advisor Ratings, a data-driven financial technology business. Mark joined the business in 2017 after working in the retail wealth management industry for over 23 years in roles spanning research, business development, product development, and executive management. Mark has a passion for building greater trust in and exposing more consumers to the long-term benefits of good advice. And I'm sure this presentation will be packed full of insights to help you achieve exactly that. So I won't hold you back any longer, Mark. Please take it away.
Thanks very much, Liam, and good afternoon, everybody. I hope you're all doing well. And as Liam said, coping sufficiently with this COVID-19 environment. This presentation is what I like to call a scenic tour of the industry. And by scenic, I mean it's a rapid roll through all the issues that are confronting our industry at the moment. Complex, time, further accentuated by obviously complications around COVID-19. But in summary, what we're seeing here is a massive reshaping of the retail wealth management industry. And while most of the conversations today, and particularly your interest, is going to be around how that's changing in financial advice, there's an equal movement of change and disruption and reinvention occurring with financial product manufacturers and most of the other vendors who are servicing your industry. The COVID-19 situation, I think, obviously just creates a new layer of uncertainty and challenge, I guess, and particularly create some real difficulties in predicting what the next 1 to 2 years will look like for our industry. But in simple terms, the way I think about it, and particularly if, for instance, you're an offshore investor or a big company looking to buy into this industry, in many ways, and in the most simplest way of thinking about it, it's actually looking really good. What we're seeing is a really big increase in demand for the broadest sense of what advice means, and a reduction in supply. So in terms of supply-demand balance, that's not a bad thing. So jumping into the presentation, I use this slide as a sort of a summary of the challenges that the industry is facing. And just running through them really quickly in terms of the first one. So 14% is a statistic in terms of the level of trust in the financial services industry. Now, there are a range of surveys out there, and most of them are suggesting that the reputation of our industry is at all-time lows. And that may well be the case, but I think what we're seeing in the last couple of months around COVID-19 is our industry stepping up and the trust factor going up. So you are, what I like to say, the new emergency workers for the times. Economic health is now a greater concern for consumers than their physical health. And so you are the triage workers, and I believe that what we're going to achieve over the next few months are going to put this industry in a really good position. But then we have some more of the challenges ahead. So moving on to education, I've got a slide where we'll drill into what the education gaps are in the industry. Clearly, this is a significant area of concern for advisors, and there's a lot of work to be done by all of you to meet the obligations that are set in legislation around completing exams and achieving the right educational standards. In terms of advice remediation, the price that the industry's paid from not delivering compliant advice is now being played out by the major banks, AMP and IWF, and current estimates are that they will pay out something like $11 billion over the next couple of years. My question is, what about the rest of the industry, the other 2,100 odd licensees, primarily in the privately owned space? Have they provisioned for this kind of impact? And would they be able to afford it? We move on to advisor turnover. That's an extraordinary number, 30%. That's the total number of advisors moving in some form, either switching licensees or leaving the industry. Incredible number. If you had an organization with 30% turnover inside that firm, it would be virtually impossible to operate. So we'll drill into some numbers there. Moving on to revenue challenges. This will be something that I'm sure you're all feeling. A whole range of reasons why revenues are under pressure and margins are obviously falling as your cost base has to increase to meet the requirements of legislation and to deliver compliant advice. And last but not least, licensee growth. We've got a slide on this coming up. So again, extraordinary growth, 50% of new licensees over the last 5 years. That's just a massive number. But what we're seeing is finally a reversal in that. And I'll show you some statistics on that, but we're seeing now licensees shrinking at a rate of 2 to 1. So moving on to the next slide, getting into some of the detail. This is probably one of my more positive slides in a presentation that clearly is about challenge. I think the important message here is that the consumer needs advice ever more so in the last few months with COVID-19, and affirming the fact that people who do get advice at a very high level consistently report about good outcomes and longer-term financial well-being. So we need to get that message out, and I think COVID-19 is going to prove to be a great opportunity to do that. So looking at the slide, the charts here, demand at the top left shows from an ASIC survey last year that there is substantial latent demand out there in the market. The chart down the bottom left are statistics off our own website, the advisorratings.com.au website. We've had about 20,000 customers review their advisors, and and this is what the statistics are there. When they review an advisor, we ask them at the end, what is their, to self-assess their own financial literacy. And something like 42 to 44% of them believe that they are below average. Now, I actually find that quite an extraordinary statistic. These are consumers who are being advised, and they self-assess at being below average literacy. So you'd have to wonder what the general population is like. And we know that financial literacy is one of the barriers for getting advice, somewhat perversely, because consumers are afraid of the concept of getting advice, of looking stupid, of not being wealthy enough, of not earning enough, and of course of not necessarily trusting the industry. So these are barriers that have to be overcome. But again, pleasingly, we're seeing demand growing. The chart to the right shows the total number of leads coming through our website and the first white label version of our website, which is on the Australian Super homepage. Big spikes in traffic and leads. Leads are what we define as when a consumer clicks through to reach you. And we saw the spike early in the year when the early access to Super was announced, and we've since seen further spikes in March, and April's continue on that same trend, driven by the recent ASIC announcement and the release of the instrument around the $300 cap on early access to Super. Now, Advisor Ratings is launching a campaign in the next couple of weeks called Together Australia. And you may have seen this in our newsletters over the last 2 weeks. This is an ambitious initiative, the biggest thing that we've ever done. We are hoping to bring as many consumers to a campaign website where they can hopefully be helped by you, by digital advice offerings, and simply by information that makes them more informed about their options, particularly around things like early access to Super, redundancy and financial hardship. In preparing for that, we have been talking to you about whether you want to be involved in the campaign, and that this slide and the next one are what you're telling us at the moment about what's happening in your businesses with the clients that you're talking to. So the first slide here is we asked you, so we're talking about 500 advisors have responded to this so far. We'll continue to update these statistics, but what are the major concerns of your customers? And here are the top 5. And they don't surprise, really, do they? I mean, loss of income and cash flow is the biggest one. Market volatility, obviously, lots talked about in terms of where markets are going. For some, that's about, do I take my money out? Do I cash out? And for others who are maybe in a better position and thinking more opportunistically is, where do I invest next? Job security is a big one. And I personally think that when the government benefits are removed, whenever that may be, that we are going to see a significant spike in redundancies. Don't want that to happen, but I do expect that will happen. And so I think this number 3 will become a really, really big one in the future. Early access to Super is the 4th one. There's been a lot talked about that, of course. I think there's something like a million people now have taken advantage of that program. The average drawdown has been around $8,000. But I think more concerningly for me is that a very large number of those people are actually taking out most of their Super. They tend to be young millennials, gig workers, casual workers, with no more than $10,000 in their account. So by taking out 8, as we all know, they're falling below the 6,000 limit, and they are losing their life insurance cover. So I think that's a significant concern. And one of the reasons we want to run this campaign to inform people to look at all the other alternatives before they withdraw their Super. And last but not least, of course, is health and mental health. Looking at the chart on the bottom, we also asked you what your clients were thinking about their future. Unsurprisingly, 60%, 61% feel they'll be worse off. Apologies for the dogs. 61% feel they'll be worse off by the end of this year, but only 20% by the end of next year. So that's encouraging and probably unsurprising for advised clients, where you put them into good financial plans and have got them focused on the long term, that they're positive about next year. Moving on to the next slide, we also asked you, the advisors, did you want to help in the campaign? And we asked you, in which areas would you like to help? And these are the statistics. So we've got 4 choices. We intend to put icons on our website that will reflect these areas of specialization, and will be very much featured in the campaigning and marketing to consumers. So 73% on redundancy, which I think is encouraging. given where I see the demand coming from. And you can see the other statistics. It's been encouraging to see the people selecting the pro bono early access to super button. We know that that is obviously the piece that's legislated, a $300 cap. If you're delivering that to a consumer, of course, if they go to a super fund, it would be free under the intra-fund advice provisions. How advisors will set up to deliver that advice is entirely in your hands. From what I understand, most people are looking to do that as general advice, keeping it simple, informing the individual on their options without actually delivering personal advice. Okay, let's get into the guts of what's going on in the landscape. So this is a slide, very busy. I appreciate that, but it's a snapshot of the four major banks, the assets they held. We call it before and after. Obviously, it's a transition, and it's not over. I think it's fair to say that what we're seeing with the inexorable and steady exits of banks from advice, at least, and certainly in selling down some of their other financial product assets, they are exiting from the wealth management industry. We are seeing the removal of capital. We're seeing the creation of a mass privatization of the advice industry. The balance sheet question is really important because it is certainly proving to be an essential requirement in times of distress. The $11 billion that I referred to before, which is the total cost of remediation of poor advice in the past, could not have been possible if the bank balance sheets hadn't been there. And so that's an important issue. The balance sheets are remaining in the financial product manufacturing space, of course. Banks still own most of those assets, and the new money coming in, particularly the money buying up the life insurance assets, are from extremely well capitalized Japanese life companies, for instance. So I'm not concerned we're going to lose capital on the financial product manufacturing side. And we're also seeing more capital and balance sheets coming in to buy up the peripheral assets in the industry, service providers and vendors in software and technology, for instance, research and the like. So there's plenty of capital running around, but we're not seeing it in the advice space. We are very much seeing a trend to an SME market in advice. And that leads us on, of course, to so what will be the protections in the industry in the absence of capital? Now, clearly, there's a draft compensation scheme of last resort that is currently in discussion to protect consumers in the event that they suffer loss from negligent advice. I think we're going to see a real ramping up of getting that scheme in place. It's clearly going to be impacted by the poor market performance that we're seeing at the moment. And where there is negligent advice and an advisor's become insolvent or they've deregistered, then that's where this scheme kicks in. So do expect to see a lot more rhetoric around this and a desire to get that scheme in place. Once again, the big guys will argue that it's at their expense, that they will be funding the support of the industry as the smaller players fall out, but that remains to be seen. So now let's look at some statistics on how the industry is changing at a more granular level. So we've got on the left, I'll just focus on the licensee graph on the left-hand side. We've got a graph here showing the last 5 years of licensee formation, the new licensees in blue, and the ones that are shutting down in green. For several years, we've seen a rate of 3 or 4 new licensees being formed to one. I described on the first slide how we've seen a 50% growth in total. And so that's displayed on this graph. But most interestingly, in the last 15 months, we've seen a complete reversal of that trend. There are now 2, and apologies, this graph is only up to the end of October last year, But in terms of where we're up to now at the end of March 2020, we've seen a complete reversal where there are now 2 licensees being shut down for every one being formed. That's a massive reversal. And just some more statistics around that. Of those licensees that have shut down in this last 15-month period, 95% are privately owned, 81% have only got one advisor in them, 65% are less than 5 years old, and the majority of them are 2 years old or less. But encouragingly though, 60% of the advisors coming out of those businesses are staying in the industry. So some really interesting outcomes there. Now moving to the right, we've got a current distribution curve of advisors in the industry, now numbering just under 23,000 licensed financial advisors. And you can see how we've split them out into the different licensee categories. I probably should just have defined what we mean by probably institutional and aligned. So institutional is really where advisors are employed by the organization, which will typically be a global and national multi-divisional business. So institution includes the banks where they own advisors or employ advisors directly, CFP, for instance, the super funds, private banks, those types of organizations. The aligned is, a big sector, and these are the licensees owned by the major organizations, but employing or running self-employed advisors and practices underneath them. We've seen for quite some time the institutional aligned, of course, has been shrinking, and people have been moving into privately owned. We've broken out privately owned recently into some extra categories, particularly 30 plus advisors. So we've now got 3 categories in the 30 plus, because this is where we expect to see the activity occurring. The small little 1-person, 2-person self-licensed practices rolling up, shutting down and rolling up into the bigger privately owned space. Flight to safety, if you like, a flight to the licensees that are becoming the new big 6, setting up strong businesses, balance sheets, building profitability into their models, and attracting the best advisors and advice practices. So we'll be watching that segment very closely over the following months. And just a couple of comments on the licensee model. It seems an appropriate place to talk about licensees on this slide. Quickly, we are seeing an evolution of the licensee model, again, particularly around that big end of town. The licensees are unbundling their services because advisors and practice owners want best of breed, but they're following a user pays model. So they're doing a lot of work to be able to provide you best of breed across the various services that they provide and allowing you to pick and choose. They're offering choices around having a license or not having a license. The likes of Centrepoint are following those models. And of course, we're seeing the emergence of dealer groups who don't offer licenses at all, but offer you a range of services. BT Open, probably the best known of those. MLC have just started something like that as well. We expect to see that as continuing theme. And of course, the licensees are showing more discretion as much as you are in terms of where you're choosing your new home. Licensees are also showing a lot more discretion about which authorised representatives they want to take on. So they're looking more closely at your compliance records, the amount of due diligence they're performing on your background and your client book, and your willingness to be aligned to where they're trying to take their business is increasingly important, and slowing down the transition phase that we're seeing as an ongoing theme in the industry. So let's look now at advisor movements within the industry. So the left-hand graph, once again, we're continuing the splits between institutionally owned, aligned, and privately owned. The left-hand graph is the exits and entries. Entries above the line and exits below the line. This is a graph up to the end of September 2019. Let me describe where we're up to today at the end of March 2020. In terms of entries, we've seen this huge drop off in entries last year, and it's continued into this year. And that's very much simply a factor of the FASEA obligations, which say that new entries have to be fully qualified at the university tertiary level of education, that they have to perform their professional year, and they have to have completed the exam. So those three constraints have completely slowed down the numbers entering. I expect that will pick up off a very low base in the coming quarters as we see more associate advisors and new entrants complete their professional year and exam. But clearly a complete dearth of new supply and continued exits. Now, the exits last year, we saw around 4,500 advisors exit the industry, which was a rate of about 15% of the total population. That has continued at almost exactly the same level this year. We've seen almost 950 advisors leave, but we also see advisors returning. They go off the register, sometimes to take a break, sometimes it's just a technicality as they transition from one advisor to another. But in Q1 this year, although we lost 950, we gained about 250. So the net was around 700. Moving to the graph on the right, these are switches, so advisors moving between licensees, once again, above the line switching in, below the line switching out, with the same splits between owned, aligned, and privately owned. Again, we're seeing a very consistent performance in this quarter versus last year. About 13% of advisors are switching. We saw 3,300 switch last year, and this year in the first quarter we've seen 790 switch homes. Let's talk about a really hot topic, which is very much about the industry becoming professional. The regulators have determined that the whole industry needs to be re-educated under the FASEA obligations. We know that's been quite controversial in some corners, but the requirements are there. Having said that, there's a lot of uncertainty still because the proposed extensions to deadlines, the first deadline, of course, is the end of 2020, when all existing advisors need to have completed the exam. And the second deadline is at the end of 2024, when every advisor needs to have met the minimum education standards. So as you probably know, there is a proposal going through government, but through Parliament, currently stuck in the Senate, to extend those two deadlines by 1 year. But at this stage, that has not been approved. So as far as the legislation is concerned, all advisors need to have completed the exam by the end of this year. Let me just give you some statistics on where the industry is up to on that matter. There have been 4 exams completed over the last year. 7,500 advisors in total have sat that exam. 86% have passed, that's 6,400. So that leaves another 16,000 advisors who need to sit the exam before the end of the year. And that doesn't allow for the fact that with something like a 15% failure rate, that probably another 2,000 will need to resit it. So that takes us up to about 18,000 people will need to sit over the next 7 months. There are only 3 more exam sittings. It's an extraordinary ramping up of activity from all of you before the end of the year, compounded by the fact that for at least the next sitting, it will be performed remotely. And remote exams create their own challenges. There's certainly anecdotally a lot of feedback to suggest that there are potentially security issues, the physical setup that advisors need to create, including a mirror to allow the exam supervisors to see what's around you, and just connectivity, having a good broadband connection are all things that are going to be challenging you to complete the exam remotely. So that's a huge impost for the industry before the end of the year. We can only hope that common sense prevails and that the legislation is passed, giving you another year, or there's some kind of relief provided, if only for another, say, 3 months to Q1 next year. Now, just quickly on this slide and the graphs, these are talking about the longer term challenge, which is to reach the appropriate level of education by 2024. The graph on the left shows that under the 4 pathways for FASEA, the 2 to the right, non-relevant degree and no degree pathways, together they mean advisors need to do up to 7 to 8 subjects by end of 2024. That's a significant number of people still to do that. And the graph on the right just shows you by some of the major licensees how many of their advisors to the right, at least to the right of the red line, are beyond that average. Unsurprisingly, a lot of the broking organisations where their qualifications were not recognised by FASEA have much higher proportions of advisors in the 2 pathways around non-relevant and no degree. So a lot of work ahead for the industry. Of course, it's a challenge for all of you running businesses while also having to do study. I think that's well understood, and it's difficult. And how small businesses are able to bring on new staff who have to complete professional years without generating fees is also another reason why we're seeing such a slow growth in new entries. So moving on to the real guts of the presentation, which are where it's all happening. It's around your businesses and around the revenues. And this is really urgent now too. If you're a business that has not addressed the fundamental changes flowing through the industry around revenue models, then you are really on the back foot. And we are seeing the industry starting to break into 2 groups, winners and losers, the strong and the weak, the proactive and the reactive. The strong will get stronger and the weak will leave the industry or they will sell. And so you really want to be in the first group and not in the second. There's a lot of work ahead to re-engineer your businesses to accommodate the challenges you're seeing on many fronts with revenue. Let's talk about those. Grandfathering has been well discussed, and I won't go through the graphs on the left other than to say that the removal of grandfathering will be a significant impost for many businesses. And the regulator, ASIC, is really forcing the financial product manufacturers to get on with that before the deadline. They are strongly encouraging them to remove all conflicted payments from their products well before the end of the year. And so that will flow on into your businesses, and the need to address that quickly is really important. Obviously, the LIF provisions are already probably hurting and having an impact where you do write lots of life insurance business. And last but not least, and I don't have a graph on it, is the ASIC review into managed accounts. Again, if you're a business that's prospering from the fees you might generate from managed accounts, then that's under threat too. ASIC has suspended that review into managed accounts, but I would be concerned for those businesses who are using managed accounts and generating a significant proportion of the revenues. If you've got 20, 30 or 40% of your revenues based on that, then that may be something to really look at. Having said that, managed accounts, I have no doubt, are proving their worth operationally at this time when you've had to move so quickly to address market falls and adjust client portfolios across your entire book. So revenue challenges on all fronts, and so you need to be responsive. Clearly, there's a whole range of reasons why you are going to need to be moving to fee for service. You can see the graphs in the middle there showing that the industry is moving well down that pathway, although there's still plenty of work to be done. Of course, this means a whole bunch of client conversations, those C&D clients, the ones that maybe you have very low touch, are having to be spoken to. Now, in many cases, those clients are leaving of their own volition because they're not prepared to pay the cost or the price of your advice, or you're asking them to leave. So I think this whole orphaning thing is really interesting. We actually see the orphan problem becoming quite large. We've talked about the fact that the industry is going to shrink. We think the industry is going to go down to around 15,000 advisors before we see a recovery. And we see something like $900 billion worth of advised wealth in transition. And this is where the rubber hits the road, is as you're re-engineering your businesses and the economics, that you're having to jettison clients who are sub-economic. Now, there are ways of doing that, of course, and I'm going to talk about digital advice later on, but one of the ways in which you can jettison clients but keep them close is to introduce them to a digital solution. We'll get into that a little bit more later on. So clearly your businesses are under pressure. You're having to change your revenue models, change your client base. Your costs are clearly going up. Let's just talk about those for a moment. Obviously, the costs of regulation are driving up the attention that you need to pay to the way you run your business so that it is compliant. That's involving significant increases in technology. In many cases, people are overspending on technology because they've bought too many solutions that don't talk to each other. And so there's going to have to be a rationalization of that. And this is where the licensees, the bigger licensees, are really trying to help in giving you the best of breed and connectivity between those solutions so you can process business straight through. And I'm sure you're all feeling that today in the COVID-19 environment, the need for connectivity of solutions, straight through processing and workflows that are fully hooked up without any sort of manual drop-offs. You're also seeing increased costs in PI cover. PI is getting harder and harder to get and more expensive. Now we're seeing PI cover in the order of 2.5% of turnover is sort of the new rule of thumb. And licensee fees, of course, are definitely ramping up. For those operating under the bigger licensees, you will be seeing those numbers climbing considerably as the licensees, as I've said earlier, are positioning themselves to be profitable, sustainable businesses in the absence of product subsidization. So first authorized rep fees now heading towards $40,000 to $50,000 for a lot of the big licensees, with subsequent advisors charged at $20,000 to $30,000. When you get to about 150,000 cap, 150,000 on fees typically now being capped, the licensees are very conscious that they don't want to lose you to some kind of self-license arrangement. And $150,000 in licensing fees seems to be that cutover point where a lot of practice owners say to themselves, I think I can do this myself. So that's all some of the considerations I'm sure that practice owners are looking at when they think about how their revenues are changing. So we've talked about some of the economics of running an advice practice. It's getting tougher because your revenues are under pressure and they're probably declining and your costs are going up. So we're seeing sort of margins being squeezed by 10 or 20 or 30% at least. Some businesses who are really on the front foot are actually reporting increases in revenue and improved profitability, but these are very much in the minority, and most are just struggling with staying afloat. For the businesses in the space around the $200,000 to $500,000 in revenue, and there are a lot of those, I think, are doing it really tough. These are typically one advisor, two advisor large practices. This graph here, this slide here shows you that distribution of practices on the left-hand side. Almost 9,000 practices across Australia, so many of them small, one and two advised businesses large, typically in that $200,000 to $500,000 in revenue. We asked advisors late last year, or practice owners at least, were you a willing seller? You can see the statistics there. 17% of those surveyed said that they were willing to sell their business in the next 12 months. And that equates, if you extend that out to the entire market, to about 1,500 practices, and according to our data, almost $200 billion of funds under advice. That's a lot of business in transition. So you can see the splits there. I won't run through those, but clearly it's a buyer's market right now. The volume of transactions have really slowed down, and it's really tough to get a deal away. The amount of due diligence has gone through the roof. The purchase terms will be very onerous for sellers, and valuations have clearly dropped. And down the right-hand side, you can see that there are different valuations and multiples for different types of revenue. Just conscious of time, so I'm going to keep moving on. Moving on to the new advice model. What you see here is, let's talk about this. I think this COVID-19 environment is a perfect time for face-to-face advisors to think about how they can leverage this kind of emerging technology. And I'm talking about the front end. I'm not talking about the technology you're using inside your business to be more efficient and productive and to manage your compliance. I'm talking about the front end, the engagement with the consumer. What you see here on this page is a whole bunch of B2C robo or digital advice providers. And I use that word advice very carefully because most of them are actually not delivering comprehensive advice or personal advice, but they are helping consumers organize their personal finances. We asked, as part of our research, we asked these 50-odd firms, I call them the digital revolution there, the ecosystem that's emerging in the absence of capital from banks. What are you doing? We said, how are you traveling? They said they were doing pretty well. 50% of them believe they're scale-ups and have moved beyond startup phase. While they were all originally selected by me, and they're on our website alongside all of you, most of them were B2C. What we heard recently was that they're all shifting aggressively to B2B to C. They're looking for partnerships with firms like yours, banks, super funds, fund managers, and platforms. They're also looking for partnerships outside our industry with retailers and car clubs and employers. So they are really aggressively looking to connect with you and to consumers. We also saw that they're rapidly moving from providing general advice to starting to provide limited personal and comprehensive personal advice. So there's a big transition going on here, and we're now starting to see capital emerging in this sector. We're seeing the likes of the banks talking about investing in digital. AMP have talked about a future with digital and face-to-face, the hybrid model. Vanguard has brought out their big US personal investor platform. Aberdeen Standard has partnered with Hub24 to build out a front end to consumers. So it's a very fast moving space, and I'd strongly encourage you to think about these providers. They can help you with your pipeline to win new customers. Never better a time than right now with COVID-19, and they can help you with your orphaning problem, taking an invested client off your books but handing them to someone like a Six Park to manage their portfolio, but keeping in touch with them. At some point, their portfolio may grow to a point where they're economic to bring back in to a face-to-face relationship. I think we're going to see a lot more of examples like this emerging. And last but not least, before we throw to questions, we have a slide here that's really speaking to the challenge now facing the service providers in the industry. We've only got 4 types presented here. What we're looking at is the feedback from around 1,200 advisors who gave us around 10,000 ratings on these vendors. This was essentially a sentiment analysis or a satisfaction analysis from you about them. And this was done in Q4 last year. So what have we learned? Well, the first thing to say is that because your industry is changing so much, because you're having to adjust your businesses, your clients are wanting different things, and your risk profiles and risk appetites are shifting, that service providers need to be right on top of that. They need to be much more aligned to where you're going to be able to provide you the appropriate service. So that means that they have to be all across the landscape. They have to understand what that means for them from a strategy perspective, how they structure their businesses, what products that they run, what they retire and what they build, how they service you. These are huge considerations. And honestly, I've spent a lot of time over the last few months presenting this very story to a whole range of product manufacturers that I'm sure you use, whether they're fund managers, platforms, life insurers, and some of the other types of vendors that are out there. They're all trying to get on top of where this industry is going, to look around the corner over the next 1 to 2 years so that they can set up their businesses to service you and to win market share. And what we heard from advisors, I won't go through each of these charts in total, but what we did hear from advisors, and just some really simple themes across all of these different types of vendor categories. They want the most contemporary offerings. They want to be able to plug and play different providers because they're moving or they're changing their business model, so they need plug and play. They need connected straight through processing types of solutions. So that's very much, now we're talking about platforms and financial planning software, how they play together and how they connect to the consumer. They have to be obviously cost friendly, so they really have to be helping reduce cost, not increase cost. And most importantly, which was coming through in the comments, the anecdotal comments left behind by advisors, the greatest driver of these satisfaction scores on this chart were the support provided by the vendor BDM and PDM teams to you. That was stark. And whatever that might look like, whether that's face-to-face, of which of course is now a moot point, but that high quality, frequent contact when you need it to help you out. And that extended to things like call centers, chatbots, just having a really connected service model to help you out in your challenges and as you're in transition in particular. So that's probably all I'm going to say on this particular chart. There is just so much going on in that vendor space. They're also being driven by regulation, which is, and the most significant piece of regulation that's impacting them is something called the Design and Distribution Obligations Act. This is arguably very welcomed by financial advisors because it's essentially putting financial product manufacturers on the hook for failed product performance. Essentially, they're sharing in the best interest test with you. If a product fails or a product was not in the hands of the right investor or consumer, then the financial product manufacturer has some obligation to make good. So this is a new piece of legislation. It doesn't come into effect until next year. And there's a lot of work to be done before both the vendor industry and the advice industry completely understands how this will work. But it is coming, and it's something to watch out for. And just to finish, and I won't talk through this, but when you put all the research that we've done, all the information that we've collected from you, from licensees, from the vendors, and from consumers, we've stitched together this image of the average advisor. Now, the reality is there's probably no advisor that actually looks like this because each of these different boxes and statistics are independent of each other to some extent, but we often asked is, what does the average advisor in Australia look like? Well, here it is. I'll let you read that at your leisure, and we're ready for questions, Liam.
Thanks, Mark. That was a fascinating insight into what the advice landscape is really looking like. And listeners, we hope you've got some great food for thought there. And as Mark said, we are now open for questions, so it's not too late to ask something. You'll notice in the taskbar there's a question panel, and you can ask any questions, and we'll try to get through as many as we can in the next 10 minutes. And for those asking, Will they receive a copy of the slides and this presentation? Yes, it is being recorded, and you will receive that in an email in the next week. All right, Mark, we'll jump in. I've got a question here going all the way back to licensees. You mentioned there's a new Big Six in town. Who are those Big Six?
Yes, good question. Well, that'll keep changing, of course, but I would say, well, of course, you can't ignore two who are already in the Big Six, which is IWF and AMP. But in the privately owned space, you've certainly got the big accounting groups, so they do dominate. Eastern Investments, who own GPS Wealth and Merit Wealth, dominate. The SMSF Advisor Network, now with about 800 to 900 advisors, down from about 1,100, is another huge player in that space. And you've got groups like Morgan's, the bigger brokers, Morgan's, Centrepoint, GPS, Centrepoint and Fortnum, sort of the names emerging in that space.
Excellent. Yeah, on the slide before this one where I had all the service providers, we saw that the planning software looked like it was going into retreat. Is that because it's being replaced, or what's happening there, and who's it? What's it being replaced by? I'm
just going back to that. Yeah, so that's a really good question. Yeah, as I say, I could spend an hour talking about each of these curves, but yes, it's a lot of red there, isn't there? It doesn't reflect well on the incumbent financial planning software providers. Well, let me say first and foremost that we're seeing some consolidation there. We've had Bravura come in and buy Midwinter, of course, and we had Morningstar come in and buy Advisor Logic, and I think that's great. I was saying before, early in the presentation, we need to see strong balance sheets in this industry, and we're seeing that in financial planning software. So hopefully that leads to some improved sentiment, certainly, but we'll see those balance sheets being put to work, improving the quality of the software, improving connectivity with other services that those companies provide, and I'd like to think that we're going to slowly see a reversal of those sentiment indicators around financial planning software. You're also going to see this connectivity between financial planning software and platforms, and whether platforms come in and start buying up some of the residual assets in financial planning software, and how the digital advice piece fits in, that consumer front end piece. I don't have the answers for that, but it's something I think about and look at really carefully, is that fully stitched up and connected consumer interface to software to delivery through platform.
Well, I hope that answers that question. Do you have any stats or examples where orphan clients are starting to be served by digital advice?
I missed the start of that question, sorry.
Do you have any stats or any examples where orphan clients are being served by digital advice?
I don't have a lot of stats, probably more anecdotes. It's still, I think, far too early to have any information on that. So the anecdotes I did touch on before, I think. So in terms of the front, when it comes to digital, I tend to just think of the funnel at the front end, and the benevolent transition at the back end of advised clients to some kind of digital solution. So at the front end, it's really, first and foremost, we're seeing the emergence of a bunch of fact-finding tools, smart digital fact-finding tools, which can unload the advisor from performing that work at the beginning. And we're seeing that within solutions like MoneySoft and MyProsperity. There are other digital fact-finding tools out there being built. And then you've got slightly more advanced advice solutions that do that kind of stuff as well, like Map My Plan and Fiducian. These are still businesses that are helping clients before they reach you, but can unload your business, and you can take those clients as they mature and grow and become more economic. They are increasingly connecting to advised businesses to feed those customers into you. At the back end, the same thing can happen. You can have investing tools like again, on the slide we had, there are lots of robo investing tools, mostly using managed account structures and using passive ETF portfolios that have performed pretty well, I might say, during the downturn around COVID-19. They can be how you transition your sub-economic client investment balances into a digital solution that allows you to stay connected to them and informed about how they're performing until a future date when you might re-engage.
Yeah, excellent. We have a question here actually relating to advisor ratings itself. Obviously there's some advisors on your website who are rating extremely well and doing a fantastic job. Is there any sort of trends or themes you're seeing with these advisors that they're doing that is getting them such good ratings and popularity?
That's a reasonable question, isn't it? Well, let me say that essentially all the ratings on our platform are extremely high. Now, there are two ways of looking at that and saying, well, that's understandable because advisors do make a massive difference, which I believe they do, and therefore they should be rated highly. So that's true. The scores are very high. We'd like to see a greater variety and diversity of feedback. I think I know that no one really likes to get a negative score or a negative report card, but I think a little bit more balance will help the relatability and believability of those results. But by and large, everyone's scoring well. The advisors who are, probably more importantly, the advisors who have claimed their profiles have got a really good digital profile and have got some reviews, are getting far more leads on our site than the people who haven't done that work. We're talking 6 times more leads coming to those advisors who are engaged and actively getting reviewed, and whether those reviews are good or bad, getting those leads over and above the people who aren't engaged.
Yeah. Another question is, you think the number of advisors might fall to 15,000 in the short term? Do you think it'll flatline there for a bit, or do you think we'll start seeing an increase again shortly after, and what will it take for that to increase?
Yeah, I hope it returns and recovers. I think we need to see the exit slow down, and we need to see the pipeline of new talent coming in really grow. So that doesn't happen overnight. The talent coming through the universities, I think groups like Strive are doing a great job in trying to encourage more talent into the industry. So we need that supply, and that may not just come from universities, but from job change. I hope COVID-19 again demonstrates that the advice industry can step up and help the Australian community, and it reflects well on our industry, and the reputation grows and it attracts more people. So we need new supply. We need to slow down the departures. And I guess that just stepping into a slightly controversial area for a moment, it was very interesting to see the government in the last couple of months through their instrument opening up the ability for tax agents and non-licensed accountants to provide advice specifically around the early access to super. Now that, in my view, was clearly a massive reversal of the trend to over-regulate the advice industry, but was very much a cry for help to drive more capacity into the industry. So I don't believe that will be more than a very short-term trend. I do wonder whether it's going to encourage more accounting firms to license and start providing services. Certainly, H&R Block took the bit between their teeth and partnered with a robo to be able to deliver simple financial advice under the robo's license. Now, there's an interesting new way of thinking about how to service customers simply. I think it's a great catalyst for us all thinking about how do we grow the population in our industry compliantly, but in different ways. There are different models for the ways we can do this. And I think it's also driving a conversation around the long-term growth in simple advice, scaled advice, limited advice, episodic single issue advice.
Right, thanks.
So I'm not sure if I completely answered that question. I went around the a few corners there, but yes, I do anticipate it will grow from 15,000 within the existing advisor industry. I think we might see new supply coming in from other aligned professions, and I think digital can really grow our capacity to service consumers.
Yeah, good stuff. Unfortunately, Mark, we're going to have to wrap up there. Sorry to all of the listeners who have asked some questions there that we just didn't get enough time to get to. Final question for you, Mark. If people want to access the full financial advice landscape report and help out with the campaign that you've got running, how can they do so?
Just drop me an email. We distributed the mini version of this report a few weeks ago to every advisor in Australia, so happy to do that again.
Yeah, we can include that in our follow-up email, which you'll receive.
Yes, we'll make sure it's part of that, Liam.
No problem. Listeners, thank you for joining us today. Just to recap, there is a CPD point available, and you will receive that and a copy of this webinar recording and the slides within the next week. So please be patient there. If you enjoyed the webinar today, you may also enjoy our next portfolio construction webinar, where Craig Vardy and James Kingston from BlackRock will be discussing their framework for building efficient fixed income portfolios using both index and alpha strategies. If you're looking for some engaging listening while stuck at home, check out our Between Meetings podcast series. Our joint managing director, Matt Heiner, speaks to industry professionals to uncover opportunities and challenges for financial advisors, including how some are tackling this COVID-19 environment and adapting to working from home. And Mark will be recording a new one just after this, so keep an eye out for that. And we've also got another podcast series on portfolio construction, where we speak to wealth management experts about strategies that should be considered in these unprecedented times. And finally, for parents homeschooling at the moment, why not include some financial literacy skills while you're doing it? Our partner, Banker, has provided some free and fun lessons for you and your kids to do at home, all focused on improving their financial capability. So check out Banker, that's banker.com.au/at-home. The links to all of these will be included in the follow-up email. So listeners, thank you again for joining us. And Mark, thank you so much for your time today. It was a really great presentation. Stay safe, and we hope to see you next time.